All right, this question comes from Tarafter, a shareholder in Sierra Vista, Arizona, who is asking a question of Ajit. Wants to know about electric vehicles getting insurance from the manufacturer instead of car insurance companies. A recent article in the Wall Street Journal shows that though EVs are a small but growing percentage of sales, Tesla and GM are offering their own electric vehicle insurance. What will Geico do to combat this?
Yeah. So Geico is talking to a number of original equipment manufacturers as well to try and see how best they can work with the auto manufacturer and offer insurance at the point of sale. There haven't been very many success stories as yet, so we'll wait and see. Clearly, it is a very convenient way to sell auto insurance at the point of sale, but there's a fair amount of data that needs to be collected on the driver, not just the car, and that makes it a little more complicated. So we are talking to some auto manufacturers ourselves. We are hopeful that we will strike a deal with some of them before not too long. Tesla has made, and GM, they both have talked a lot in the press in terms of getting into the insurance business. And in fact, GM, I think, has projected they'll write $3 billion of premium, which, it's hard to imagine where it'll come from. But they're all hot to trot. I think somebody will find the secret sauce before not too long, and we ourselves are in that race.
Yeah, I would point out that General Motors had Motors Insurance for decades, and I mean this is not a new idea, and Uber wrote a lot of insurance for a while. They laid it off with somebody, and that company got killed by it. But and I don't know the deal between Uber and forget the name of the company that took it on. Ajit would probably know, but
James River.
Yeah, and there's nothing. It's not a new idea. It's not magic in the least. I mean, it is hard to come up with something that is better at matching risk to reward, risk to price, than a bunch of very smart people are doing it at Progressive, and a bunch of very smart people are doing it to a greater extent at Geico. And I mean, it was fascinating to me when Uber went into it, and they were going to get their head handed to them, but they laid off a good bit of it. Very, very substantial percentage of it was somebody else who got their head handed to it, and but it was a story. Wall Street loves it. And, we've got 80 car dealerships that do a lot of business, and we've got the people buying the car and the place, and we form an insurance company around the dealer group for some reason that writes insurance. It's hard to improve on the present system.
Yeah.
I wouldn't pay a penny. I'd pay to avoid it, actually. I mean, and go ahead, Ajit.
Yeah, the only point I'd like to add is the margins on writing auto insurance are 4%, which is a very small number. And once there are more people that are trying to take a bite of the apple, it just becomes very, very difficult to keep all the mouths fed in a profitable manner.
Yeah, you can say there was one big new idea in insurance and car insurance back in 1920 or so when State Farm started, and State Farm still has it next to Berkshire. It's the leader in having net worth. It's a mutual company, but some guy just figured that there was a cartel running car insurance, and Farmer from Myrna is the name of the book, I think, and over in Illinois, and he created a system where he really took 20 points or so out of the cost. And surprise, surprise, here he is, and nobody's owned stock in State Farm. It's an insult to capitalism, actually. Everything you learn at the business school says it shouldn't work because nobody owns it, nobody's going public with it, no nothing. But it's got more net worth. It's almost probably double leaving Berkshire out of the picture, it's probably double the next guy, and nobody's really improved on their system that much. So it's fascinating how people don't really look at the essence. These are cases that should carry a message. But the truth is, in Wall Street, anything can get the test is whether you can sell it or not. If you can sell it, it'll get sold. And a bunch of insurance companies came along and got it sold. And this can be a story about this stock or that stock. And it sounded good when they talked about it at Uber for a while. And it is really interesting. The investing public does not learn much.
This next question is for both Warren and Ajit. It's from Ben Knoll, who's a Minneapolis shareholder who's been a shareholder since 1995. And he says, in an interview this past year, Todd Combs said that in first meeting you in 2010, he told you Geico is better at marketing and branding, but Progressive is a data company and data is going to win in the long run. But it appears you did not prioritize data analytics at Geico until a decade later when you made Todd CEO. As business units like Geico age and need new strategic direction, I wonder if Berkshire's hands-off management approach is a source of vulnerability. Will you please review your thinking on changes made at Geico and explain how Berkshire is structured to react if the Berkshire CEO sees that a business unit is strategically off track? And Ajit, I hope you will continue to update us on yours and Todd's progress at remedying the data analytics shortcomings at Geico.
Ajit, would you like to?
Yeah. As Warren has pointed out in the past, one of the drawbacks that Geico is faced with, it hasn't been doing as good a job as matching rate with risk and segmenting and pricing the product based on the risk characteristics. This has been a disadvantage at Geico for a few years now. We are trying to still play catch-up. Technology is something that is unfortunately a bottleneck, but there again, we are making progress. And equally importantly, we have hired people who are much better than what they inherited in terms of data analytics and pricing and slicing data. So, yes, I recognize we're still behind. We're taking steps to bridge the gap, and hopefully, certainly by the end of 25, we should be able to be along with the best of players when it comes to data analytics, whether it's pricing, whether it's claims, or any other factor that drives the economics of the insurance business.
I would add that equating rate with risk obviously is important in every line of insurance business. I mean, that's what you're involved with is deciding whether a given rate offers us the chance or the probability that we will make a little money on it, and that sometimes we're only risking losing a little, and sometimes we're risking losing huge amounts. But Geico and Progressive has done a better job in that recently. But our fundamental advantage at Geico, of course, is that we have lower costs than virtually anybody, and that cost advantage has been dramatic. We've driven our underwriting expense ratio below 10%, and there's just very, very, very few companies that can compete with that. So it isn't. It's not in the least a survival question, and it isn't even exactly a profitability thing. But we would rather have X% of the market than a half of X%. But we roughly, I think in the month of March, we were just we didn't lose policyholders, and we got 16 million or whatever it is of them, and we've got the lowest cost operation. So it's not a threat. It's not remotely a threat to survival. It's not a threat to even profitability. But on the other hand, we would like to be growing with something that is the best model around in the insurance business of delivering at a low cost. And we now have a recognition that we didn't have back when Leo Goodwin started in 1936. But the same principle that worked then is that if you can offer somebody a good product cheaper than the other guy, and everybody has to buy it, and it's a big business, it's very attractive to be in. And Geico is a very attractive business and has got its lowest cost thing, and it does have to do a better job of matching rate to risk. But our low costs have masked the fact that for a while that we could do without progressing as much as we should have in the matching of rate to risk. And now Todd has been working intensively at that, and he's made a lot of progress, but there's still work to be done. But in the meantime, we're not going to shrink, and we should make better underwriting profits than most companies in the auto insurance business.
This question comes from Ben Knoll in Minneapolis. He says he's a Berkshire shareholder of 3 decades, and he's attended many Berkshire meetings. He's here again this year. And this is addressed to Ajit and Greg. He says, last year I asked you about how Geico and BNSF appeared to lose ground to their leading competitors, Geico on telematics and BNSF on precision scheduled railroading. Ajit, you responded by saying how you expected Geico to make progress in a year or two. Greg, you spoke about your pride in BNSF, but you didn't directly address the threat of precision scheduled railroading. Will each of you please provide perspective on these competitive challenges and our company's strategies to address them?
In terms of Geico and telematics, let me make the observation that Geico has certainly taken the bull by the horns and has made rapid strides in terms of trying to bridge the gap in terms of telematics and its competitors. They have now reached a point where on all new business, close to 90% has a telematics input to the pricing decision. Unfortunately, less than half of that is being taken up by the policyholders. The other point I want to make is even though we have made improvements in terms of bridging the gap on telematics, we still haven't started to realize the true benefit, and the real culprit or the bottleneck is technology. Geico's technology needs a lot more work than I thought it did. It has more than 500, actually more than 600 legacy systems that don't really talk to each other, and we're trying to compress them to no more than 15, 16 systems that all talk to each other. That's a monumental challenge, and because of that, even though we have made improvements in telematics, we still have a long way to go because of technology. Because of that, and because of the whole issue more broadly in terms of matching rate to risk, Geico is still work in progress. I don't know if any of you had a chance to look at the first quarter results, but Geico has had a very good first quarter, coming in at a combined ratio of 93 and change, which means a margin of 6 and change. Even though that's very good, it's not something we can take to the bank because there are 2 unusual items that contributed to it. Firstly, we've had what is called prior year reserve releases. We've reduced reserves for the previous years, and that contributed to it. And secondly, every year, the first quarter tends to be a seasonally good quarter for auto insurance writers. So if you adjust for those 2 factors, my guess is the end of the year, Geico will end up with a combined ratio just south of 100, as opposed to the target they're shooting for is 96. I hope they reach the target of 96 by the end of next year. But instead of getting too excited about it, I think it's important to realize that even if we reach 96, it'll come at the expense of having lost policyholders. There is a trade-off between profitability and growth, and clearly we're going to emphasize profitability and not growth, and that will come at the expense of policyholders. So it'll not be until 2 years from now that we'll be back on track, fighting the battles on both the profitability and the growth front.
This question's for Ajit and Greg. It comes from Ben Knoll, who's a shareholder of 30 years. He's a Nebraska native, and he says he'll be attending the meeting here today. BNSF and Geico appear to be losing ground to their 2 primary competitors, Union Pacific and Progressive. Over the past several years, UP's operating ratio has been about 400 basis points better than BNSF's, and Progressive has grown faster while maintaining a lower combined ratio than Geico. On an operating basis, UP's precision scheduled railroading and Progressive's telematics appear to have jumped ahead of the Berkshire businesses. He wants to know what Greg and Ajit are doing to address those business challenges.
Ajit?
Okay. Thank you, Becky. There's no question that the personal automobile insurance business is a very competitive business. Having said that, both Geico and Progressive are two very successful competitors in this segment. Each one of them have their pluses and minuses. But having said that, there's no question that more recently, Progressive has done a much better job than Geico, as you point out, both in terms of margins and in terms of growth rate. There are a number of causes for that, but I think the biggest culprit as far as Geico is concerned, and again, you rightly pointed out, is telematics. Progressive has been on the telematics bandwagon for, I don't know, more than 10 years, probably closer to 20 years. Geico, until recently, wasn't involved in telematics, and it's been only the last 2 years that they've made a very serious effort in terms of using telematics for segmentation and for trying to match rate and risk. It's a long journey, but the journey has started, and the initial results are promising. It'll take a while, but my hope and expectation is that hopefully in the next year or two, Geico will be in a position to catch up with Progressive in terms of telematics, and hopefully that'll then translate into both growth rate and margins.
Charlie, you got it? It's very interesting. I mean, the auto insurance industry is a fascinating one to study. In that the largest auto insurance company now, and we're talking 2022, and Henry Ford. I mean, it was 1903, or something when cars really got started, and it wasn't too many years after that he was turning out 2 million cars a year. Imagine that, one guy, 2 million cars a year is a lot of cars. So car insurance became very important after hundreds of years of when people thought about insurance. It was ships at sea and fire, where they had protective societies, and insurance as a product's been around a long time, but auto insurance has been pretty much the same thing since Leo Goodwin started Geico in 1936, and we came along with a good idea and lots of big companies and all that. But the largest auto insurance company in the United States was started over in Illinois by a guy who didn't know anything about insurance particularly, and it's a mutual company. It's not supposed to succeed in capitalism. I mean, if you go to business school, they teach you that only because you have incentives and compensation and all kinds of things can a company succeed. Well, nobody's really gotten rich off State Farm. They've sat there, and they are the largest insurance company. While Leo Goodwin started 80-some years ago, and he probably wanted to get rich, and probably at Progressive, people wanted to get rich, and at Travelers and Aetna, and name off dozens and dozens of companies. And who wins? A mutual company. In terms of present size, they still are the largest company. They have, if you leave out Berkshire, they got the largest net worth by far. I think they've got 140 billion or something like that of net worth. And Progressive has had a very, very, very smart guy running it for a very long period of time. They got very smart people running it now, but they have a net worth that's 1/6 that of what some people over in Illinois that nobody knows the name of have after years of, they've had the time to sell the same product, and they advertise like crazy. We spend $2 billion a year telling people the same thing we've been telling them for 70 or 80 years. The policy doesn't change, but when we get all through, State Farm's still doing more business than anybody, and it shouldn't exist under capitalism. If you went there with a plan to start a State Farm today and have it compete with Progressive, who would put up the capital? I mean, a mutual company that you're not going to get the profits from, it doesn't make any sense at all, except they've got $140 billion or something like that of net worth. And Progressive, I don't know what their net worth is, but it must be somewhere around 20 or so billion. I haven't looked for a long time. Their net worth in the first, incidentally, I mean, they are very, very, very disciplined in underwriting. And of course, on the investment side, their net worth dropped in the first quarter because they own a lot of bonds. And they say, well, probably everybody in the insurance business would say that, well, we own bonds because that's what people do. And here's half the business where you do what people do, and the other half of the business, you spend all kinds of time trying to analyze in every county and every single way you can segregate and properly rate business and all of that. And basically, Peter Lewis sat in my office 40 years ago, and he's smart as hell. And this guy was clearly going to be a major competitor of Berkshire's, and he knew insurance backwards and forwards and very bright and everything, but he just ignored the investment side, and that was as important as the underwriting side. And it is interesting how organizations function and going to have what I would say are to some extent blind spots. And of course, Charlie and I know we've got all kinds of blind spots ourselves. So we have to be kind of careful of criticizing other people for having them. But the auto insurance business ought to be studied in business school because it essentially refutes so many of the things they're presently teaching. So that's my suggestion today to business schools. Okay. And thanks, Ajit. Ajit is responsible for adding more value to Berkshire than the total net worth of Progressive. That's not to knock Progressive. I'm just saying one guy.